You're listening to The Dealmaker's Edge with AY Strauss, diving deep into stories behind commercial real estate leaders. Welcome, everybody, to The Dealmaker's Edge. Today, we're really excited to have my friend Gary Lipsky on with us. And Gary is a sponsor of multifamily real estate. He's done over $250 million in real estate deals. He's the president of Break of Day Capital, whose mission it is to positively impact the lives of their investors and the communities in which they invest through the highest level of transparency and fiduciary responsibility. Besides many other awards, Break of Day was rewarded the 25th fastest growing real estate company in the U.S. And Gary is also a fellow podcaster, where he's the host of the Real Estate Investor Podcast, which is a fantastic podcast to check out. And he's also the best-selling author of Best in Class. And Gary's also a prolific speaker, constantly speaking at conferences across the U.S. And as a successful entrepreneur, Gary's built several companies, co-produced 3 independent films, and also started a nonprofit. So you've done a lot as foundation for your multifamily investment career. I know you're juggling a lot, and thank you for making the time to be here today, Gary. It's great to have you.
Absolutely. Thanks for having me.
So there is always a natural point to start these conversations for people who are not familiar with your story. Maybe you can take us back towards, you don't have to go way deep into childhood. We try to get a sense of education and upbringing and sort of what got you started in the business as just a kickoff for the conversation.
Hey, I've always had like an entrepreneurial gene in my body, I guess. As a young child, I grew up in New Jersey, and we would shovel driveways during the winter and auto detail cars during the summer. I taught some sports programs at a YMCA. And during college, we started a restaurant delivery service, kind of like Postmates. They have a name now, and DoorDash. And we set some people up to run it when we went back to college, and they kind of ran it into the ground. But never really worked for anyone else. And always I wanted to kind of bet on myself and just started some different things. And my journey has certainly woven between different industries, but those same skill sets are always transferable. And then found my calling, I feel like, in real estate, where I can utilize my creative and my business side of my brain.
Perfect. And maybe we could talk about how you made that leap. I mean, at one point you were doing other businesses, and eventually you had to buy your first asset, and you picked a market geographically, and you had to build an investor base from scratch. You had to build your track record from scratch. So a lot of people listening to this podcast, some of them may be already very experienced, but perhaps a lot of them are just starting out. So maybe you could talk about how you made that just sort of initial transition.
And, I had a single family rental, and even the houses that I was buying personally for my family, I would really study the market and be in a place where they had good schools and a house that I can add value, whether it's opening up the kitchen or adding an office to the garage, whatever it was, I was adding value to the property. And I didn't know at that time that it was good learning lessons at a very small scale of what I could do. And when I sold the business at the end of 2016, I got into real estate full time. And it took me a little bit to figure out where I wanted to be, because there's so many ways to make money in real estate. And found multifamily, which is like running a business, running a franchise. And I thought I needed to do a lot of like small stuff to build on my resume, 6 unit, 8 unit, 10 unit. But I had gone to like an investor group thing, and they talked about partnering up with others and scaling up. And that was really important for me, because instead of doing a lot of small buildings for many years to build up a resume, a few of us partnered up and bought a 42 unit. And it was only $1.65 million, but that kind of got us on our way to raising capital from others and getting our feet wet into syndication.
Perfect. And obviously, I had to pick a market, and I want to talk about subsequent deals after that, how you even decided that you trusted these individuals to partner up with you on your first deal. I know that integrity is not built overnight, but obviously you're sitting in California today as we talk, and Phoenix has been a main focal point for the portfolio, and it's a growing market. If there's any market to pick, how do you laser in on that geography? How do you get started there? What drives that market? What's so exciting about that market for you?
Yeah, so we wanted to be in a landlord-friendly state that had low cost of living, that the units were cheaper, certainly than California. It was easy to get to. It was business-friendly, had good population growth, good job diversity, and a diverse job market. And so we had been looking in Phoenix for a while, and actually our first deal was in Tucson, And at first, I didn't love the median household income. You drive around. I didn't fall in love with it, but I really liked the economics of this deal. And over time, we really learned to love Tucson. We're under contract on our ninth deal there now. So Tucson has become a real focal point, probably for the reasons why I kind of was not that impressed with it in the beginning, because owners overlooked those properties there. Even the ones they own, they don't know where they could push market rents. And so we've been able to come in and buy apartment buildings on the cheap and drastically improve the property, increase the rents, and provide massive increases in NOI, a 40% increase across our portfolio in the first 12 months of all the deals that we've bought.
That's fantastic. And talk about how you teamed up with those initial partners early on. I mean, it's stressful. A lot of people want to go buy something. They all want to start small. And by the time you start small, it took up half your day anyway. You may as well go a little larger to start. But that trust level and skill set and finding those people, how do you make that leap of faith?
Yeah, absolutely. So I was going to a bunch of real estate meetups in Los Angeles and running into one of the guys constantly. And so I know that he was driving out to Phoenix and Tucson at 4 a.m. and coming back, really late at, end of the day. And so we started going together versus going separately, and knowing that he was willing to put in the work and we saw the same things in deals. And so that was built, like you said, over time. It wasn't overnight. We spent many long hours talking and finding out that we had kind of the same ethics and desire to take down these deals. And one of the other guys that we partnered with, he had developed a relationship. I knew the guy and had spent time with him. So between the three of us, we were able to raise, we had the net worth, the liquidity, raise enough capital to get the deal done.
Fantastic. And then obviously management constantly scaling as you go and grow, and having partners, different skill sets augments and supplements or diversifies the other partners' skill sets, which is great. One of the things I want to ask you about as well is you're a prolific marketer. I interact with a lot of sponsors, a lot of investors, and everyone markets differently. Some people do huge deals, which just attracts a lot of media attention organically. Some people are just great at networking, but it seems like you've really carved a great brand. Not only you host a successful podcast, you take the time to travel and speak and educate, not from a selling perspective, but you invest in the knowledge community, knowledge giving, which is very generous. And you wrote a book. That takes a lot of time, a lot of energy. A lot of people just don't push themselves to do those sorts of things. What inspired you, and how do you view the marketing component as it ties into the operational component and the management component and the fundraising component? How has that helped you? Or perhaps would you have done things differently?
Yeah, I was very slow in building that kind of the marketing aspect, because when you start off, you have this kind of imposter syndrome. I don't have a track record. I've been very successful in business in the past, but this is something new. And so I came at it from a perspective of, I want to learn from others. And so I would host webinars. When I started the podcast, it was to learn from others. And so I've done about 170 podcasts, and I'm bringing on people that I wanted to learn from, that I respected, and ask them questions about asset management. And that was focusing on asset management really allowed me to build that brand. So we wrote the book, Best in Class, which there's no book out there that I know of on asset management for real estate. And it really helped us get people talking about that, not just the last 6 months, but we've been talking about it for years. And other podcasts, conferences would ask me to come and speak on that. And it really helped me, forced me really to refine my skills. We were really focusing on it, but hey, if I'm going to write a book about it, I better really know what I'm doing, And so we shared all the different things that we were doing and put it on paper and shared it. And there's probably not a conference I go to that someone doesn't walk up to me and say, hey, I've read your book. It's really helped me.
Absolutely. And how about from an investor perspective? I know syndicators are always in fundraising mode, whether they're raising formal funds or whether they're raising high net worth, family offices. Obviously, it provides a great way to study your approach, your philosophy towards investing and asset management. But can you point to specific instances over the course of the last several years where having that brand, having that marketing infrastructure, having those speeches has led to actual investors?
Yeah, absolutely. There's not one thing that I could say I get most of my investors that way, but it's a number of different things. They're seeing me speak at conferences. They're hearing what others are saying about me, that others that I've helped or build trust, other investors that are referring or talking about things they've heard about me. So there's so many different things that help an investor come on board. There's not one certain thing, but yes, you're building a body of work, and hopefully, maybe someone doesn't invest in your first deal or your third deal or your fifth deal, but once they come on board, we're always like, hey, we have a minimum, but we'll work with you to invest with us, because we feel strongly once you start investing with us, you'll never leave, because you'll like how we communicate, you like the deals that we pick and how we do things. And that's really been the case. And our investors keep coming back and they bring their friends a second time. And we don't strive to be the biggest organization or do the most deals. We just want to focus on good quality deals. And the one we have under contract now, it'll be the first one we've done in about a year, because we don't need the fees to cover our overhead and then just do deals. We're going to be very specific on the deals that we invest in. And I'm one of the biggest investors in all of our deals. So we're not just doing it just to do deals.
For sure. And we've talked about offline, just obviously the last year or so for commercial real estate, all asset classes at some level, certainly with the rates and all the headlines, and we know all of them, raising capital. It's a constant effort. And even though you've done a fabulous job, and even though you've created returns, once the headlines are negative, and obviously for good reason, the headlines are negative because there's really negative things happening, investors get spooked. Investors are slow to invest. There's harder to raise capital, and you need the deals to continue to build those relationships with investors. Maybe you could talk about fundraising today for this new deal versus maybe a deal going to market a year ago. Have you seen the climate improve? Is it sort of the same? What's the vibe out there for sort of that private high net worth investor that you're currently talking to probably on a regular basis?
Absolutely. It's harder than ever. I think last year, maybe it was like April where you kind of hit the wall, but now there's just, not only do you have the negative thinking, but when things are in the media, but you also have capital calls from other operators that are affecting investors, that they either have no money or they're frustrated by investing in other operators. And so they don't have the capital. As an organization, we'll raise more money than we ever have for this deal. But I mean, it hasn't been a fast raise, I'll tell you that. In the past, we'll have a webinar and we know really by the end of the webinar where we stand, like we're feeling really good about it. This is just there's just a lack of urgency, I'd say. We have a first wave of investors, and then the other group are just kind of thinking about it. They'll come in on their sweet time, but we'll get there, but it's not an easy time. And everyone I speak to, they can either raise half as much, or they just really have given up raising capital until maybe second quarter next year. It's very difficult times right now for raising capital.
Absolutely. Certainly in the individual private investor sphere that we specialize in, that high net worth investor, that passive investor. Maybe you could talk a little bit. I mean, maybe you don't want to talk about deal specifics. I know things are under contract. People get nervous. They get spooked. But just broadly speaking, in your market, which you're really an expert in, you have to have the deal flow. Everyone's been complaining, well, either I'm not going to invest in deals, look at treasuries versus cap rate, look at returns. People are talking about negative leverage for the first time in years. You have to find these deals. So what is this deal penciling to, or another deal that you've looked at that you would otherwise buy in the last few months, look like as far as metrics, economics, that would be compelling to you in today's market?
Deal flow has been kind of up and down all year round. And of course, when I'm on vacation, I'm in 3 best and finals. That's how it aligns. And a month will go by where we don't have anything. I remember talking to a broker at the national conference in January, and they were saying we did 29 deals in 2022 that were 100 units or 29 sales. They predicted 8 sales this year of 100 units or more. And that's probably like an overestimation. I don't think, and in Tucson, there'll be 8 deals that have traded 100 units or more, just to give you a reference point. But we're looking at debt is a major player, because you're getting less debt, but you're getting less leverage. You're paying higher rates. You might have a high prepayment penalty. So you just have to build it into your underwriting and have to factor in perhaps lower rent growth, depending upon what market you're in. I mean, there's been some markets that have negative rent growth. But as long as you underwrite correctly, you build in lots of buffers, you build in lots of working capital reserves, then you can kind of figure out if this deal is good or not. And we'll underwrite pretty much most of the deals within our sweet spot so that we have those data points to know if a deal is good or if a deal is bad, where the market is headed. Is it getting better? Is it getting worse? And so just having those data points, vintage, how many units, the median household income for a property, all these different factors, and then we'll see where we could take the deal. So we're not that concerned with the going in cap rate, but because it could be a lower going in cap rate, but if there's so much meat on the bones, and we can bring it to, if we buy it at a 4.5 and we can bring it to a 6 in a year, then that's something that's really worthwhile. So there's a lot of different factors that we're looking at. So we'll just be aggressive, take the time to underwrite pretty much everything to see where the best opportunities lie as well.
Sure. And in your underwriting, and again, no one has a crystal ball, and it's kind of an aggravating conversation at this point about rates because it's kind of annoying, right? But I'm just curious, when you do your projections, when you do your Excel spreadsheets, et cetera, rent growth is a constant determinable moving factor, but are you projecting and predicting, sort of rates maintaining upward trajectory over the next year or two, or are you sort of predicting more stabilization? Obviously a lock in long term, but still.
So we won't put where we think rates are going in our underwriting. We feel very confidently that rates are going down, but we don't want to put that in our underwriting because that's not a great safeguard for our investors. So we'll assume rates are basically the same going forward. We strongly feel rates will go down. We've seen a lot of different reports, but we're going into our election year. The Fed is going to break something. We're starting to see it. They have a ton of debt that's coming due, and they're scared to say this is the final increase because at that point, everything skyrockets. The stock market jumps, prices jump up. So they're trying to temper feelings until they have to lower rates. And I think that will start happening maybe end of first quarter, early second, and continue for a bit. And I think things will get frothy before you know it because there's just a ton of money sitting on the sidelines waiting to be spending. You're just not, so many people are sitting on the sidelines right now, and there's this huge buy-sell gap that we've been seeing for a long time, but people are ready to pounce, and there's going to be opportunity out there, particularly with deals that are feeling the crunch with the debt service, loans coming due. So there's going to be a lot of, I'd say, chaos in the next year or so.
Yeah, and that's a great point that you bring out. I speak to a lot of people too, and everyone's sort of waiting for this distress, and it's obviously going to happen and is happening in real time. But distress means something different, obviously, to everybody, wherever they stand in the capital stack. I'm curious what it means for you. I mean, are you thinking or are you seeing in real time opportunities where somebody, did take out that variable rate and the debt's maturing in the next 3, 6, 9, 12 months, and they just will not have enough equity even for a cash-in refi, or they're looking to sell now as opposed to having to come up on that? Or, I mean, we're seeing on our side a lot of capital calls, and how do you deal with capital calls? But from your perspective as a buyer, how does that look and feel for you? What type of opportunities are you seeing out there?
Yeah, I haven't seen any of the sellers panic, which is, some of them should be panicking, but they're staying true to the numbers, what they're trying to get. And those deals aren't necessarily selling. I saw one deal on the market that I looked at probably 6 months ago, and now it's come down 40% at least. So there's an opportunity, and it's an adaptive reuse project. So your buying pool is much lower, but you're seeing some workouts from lenders or deals that are kind of getting sold behind the scenes that are feeling distressed debt. So I don't think there'll be a tsunami of those opportunities, but there will be those out there, and you're seeing them here and there. But usually those aren't the sexiest deals. Like one was like, I don't know, 250 units of all studios and one bedrooms. And they were willing to sell it for maybe $8 million less than they paid. But, given the unit mix, it still wasn't sexy enough for us. So you're seeing some opportunity, and there'll be more, but I don't think it'll be a tsunami of opportunity.
Yeah, and I think that's what people are coming to realize. They've raised all this capital. They want to do deals. They're waiting for this sky to fall. And I think there will be pieces of the sky falling, but at a certain point, if you're set up to do deals, eventually you have to do them. And if you get a sense where the rates are, and you can underwrite, and you can make some good things happen if you take a long-term approach. And I think that's been your style, which is going to win out over time. Talk to me about this is called the deal maker's edge. So besides interviewing people who are sponsors, investors, and syndicators and so on, we also try to get into the headspace. I mean, you are currently navigating, and you've navigated a difficult period. And I think it's actually wonderful long-term for all these wonderful sponsors, because stormy seas make good sailors, as it were. But maybe you could talk about that bad day, right? I mean, you have to keep a good face on, and it's stressful. You have to juggle teams and investors and marketing, and you have a ton of things to do. How do you sort of manage the day-to-day stress, which comes into operating a successful business and having that growth-minded trajectory, which is sort of layering on more pressure, good pressure nonetheless? But how do you talk to yourself in the rough times?
It's definitely stressful. When you have hard money down for a deal, whether it's, today it's less money, but last year it could be $500,000, could be $1 million. You might be waiting for a deal to sell, and that gets delayed, and it's affecting buying other deals. One thing important for me is never really miss a workout. And so if I'm working out, whether I play a lot of beach volleyball, walking on the beach, hiking, that really takes my mind off of things, burns off energy, wasted energy, versus me just overthinking. And so I could just focus on the task at hand. And that's really important. Being an entrepreneur, being a leader of a company, it's a very lonely world. So you've got to be a part of other groups where you're around like-minded individuals. So I'm a part of 2 masterminds, and that really helps me because I can hear what other people are struggling with. Hopefully I can help them and they can help me. We could bounce off ideas, things I didn't think of that they may be approaching. Those things are really, really valuable, and it's just really investing in yourself to have that self-care,
Well said. And I think everyone manages that stress differently. Some people just love it. But those people are hard to relate to, I think, at times. Well, let me ask you this. Somebody makes time with you. I'm sure every day somebody reaches out saying, hey, Gary, I want to get on your calendar. I'm a kid out of college. I'm 2 years working at some institutional. I want to sit down. How do I get started? What are some of the big picture thoughts and philosophies for what is truly a long-term game? You're playing the long-term game, and you've been in it a while, and you're going to go much further. Maybe to save you the time, to spare you some future cups of coffee. Not that you wouldn't continue to do it. I know you're very generous with your time, but what are the types of key themes you're talking about to these individuals who are, more at the earlier stages, besides the technical note, how to get their head in the right space?
Yeah, I always say don't go it alone. There's a lot of different syndication groups or investing groups out there. And so just being around other like-minded individuals gives you rocket fuel. You may find your next partner. You may find your next investor. Those are just tremendous groups to be around, because in today's society, there's no reason to be insulated. Be around other people trying to do the same thing as you. That will really, really help you.
Fantastic. Anything else I didn't ask you, but that I should have asked you during the course of this conversation? That's a good catch-all. I never know if there was something I completely missed, but feel free to add what I may have missed if there is something here.
For us, and I think this bodes well also for an early investor too, is there's so many shiny objects in real estate. So, and I see it all the time. I see friends that are looking in Florida, and then looking in Texas, and then looking in the Midwest. I'm like, focus. Pick an asset class, pick a market, hone in on that, and you will do really, really well. Kill it in that area, and then you can expand. And that's what we do. We focus on a few markets. We focus on value-add multifamily. We're not trying to do too much, trying to do what we do really, really well. And we don't even have to touch anything else, any other markets or any other asset classes, and we'll do phenomenally well. We can get to $1 billion or more assets under management. And so that's what I like to tell other syndicators, other investors, just narrow your focus down.
Well said. Among many other lessons, very well articulated, Gary. And again, I want to thank you for being on. It's been a wonderful conversation. And I hope the listeners of this podcast check out Best in Class, the book, check out the podcast that you've been running successfully, and follow your story as well. And I'm going to continue to do so. And hopefully after this deal you have under contract closes, you can ping me, because I'll be excited to hear more about it. In any event, Gary, thank you again, and to be continued. And again, I really just appreciate the time so much.
Thanks for having me. I really appreciate it.
Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. Give us a 5-star rating so more people can follow the conversation.